Hello, everyone, and welcome back. Listen, we're going to get right into it, okay? Velocity banking versus the debt snowball method. Which one is better? Now, there's been a debate about the velocity banking method ever since its inception, okay? Ever since its advent upon mankind, whether or not velocity banking is better than the debt snowball method. But what I want to do is I want to let you know that with the velocity banking method, we don't just uh, go by hearsay. We go by the numbers and we let the audience, we let the fans, we let the subscribers, right, in on the numbers, and then they decide for themselves which one is better. All right. So we're going to go ahead and hop into it right now. Velocity banking versus the snowball, the debt snowball method. Listen, with the debt snowball method, we know four things: that we have to list our debts in order from smallest to largest, right? That we got to make the minimum monthly payment except on the smallest one. And then we got to pay as much as possible, whatever that is, right, to the smallest debt. And then number four, we just repeat the whole cycle again. However, is this the best way to get rid of debts? We're going to find out. All right. Listen, whenever you're in the velocity banking method, there's one thing that you notice. One thing. What is that? And that is you notice that there is an increase in your cash flow. Can anybody tell me why, when you institute the velocity banking method, there is an increase in your cash flow? It's because you no longer have that minimum monthly payment on the line of credit. Remember, with the velocity banking method, you're using your line of credit as your new checking account. So when you get paid $1,000, when you get paid $2,000, when you get paid $3,000 for that month or for that week or whatever, all right, it goes into your checking account first, and then where? The line of credit. And that's what you'll use, right, to pay all the other expenses, including any loan. Did you catch that? Not just the mortgage, not just the car loan, any loan in your personal line of credit. You're going to be using your personal line of credit to pay any loan and your expenses. All right. So that's how the velocity banking method increases that cash flow. Now, knowing that, let's hop over and take a look at the snowball method. Then we're going to go ahead and contrast that with the velocity banking method. Here we have some numbers. Oh yeah. $500 for, let's say, the medical bills, right? $2,500 for, let's say, he says, right? Other people say credit card debt, but the credit card is never a debt. Do you know why? We'll get to that later. $7,000 for the car loan, and then $10,000 for the student loan. All right. We see these minimum monthly payments of $50 a month, $63 a month, $135 a month, and $96 a month, right, in that order. And they're saying, excuse me, that you need to pay the smallest debt first. Pay as much as you can, as much as you possibly can, to the smallest debt. I say don't worry about that. Don't worry about that. Okay? We don't need to do that. What we need to do is make sure that we got a line of credit, right? And then let's make sure we know how to prioritize our loans according to the cash flow index number. Okay? The cash flow index number. You're going to want to write that down. CFI stands for cash flow index number. Now, when we have these numbers in front of us, yes, it seems smart to pay as much as possible to the smallest debt. That way you get rid of the $50 a month and you can put that into the next smallest debt, right? However, when you have a line of credit, you can pay all of that off in one fell swoop. All of it. and when you're using your line of credit and as your new checking account, do you have a minimum monthly payment on that line of credit that you just got rid of all these loans with? No. Look at this. You don't have to worry about any of that. Okay? Because you're using your line of credit as your new checking account. You don't have a minimum monthly payment. So if you wanted to do that, you can. Okay? That's the freedom in the velocity banking method. However, if you don't want to do that, you don't have to. You can prioritize your loans like this. So we're going to take the CFI, right? And is equal to the loan balance divided by the minimum monthly payment. So let's say the loan balance is $500. We're going to divide that by the minimum monthly payment, which is 10. Okay, so in this case, out of all of these elements, which one do we pay off first? That's right, we do pay off the smallest first. However, when we get down here and we see this number right here, this number, $10,000 in student loan debt, $96 a month. Where is that on the CFI bar, the CFI indicator, the cash flow indicator? Where is that? That's 100 plus. All right. That's 100 plus. I think it's 104. And so what does that mean? That means you don't really have to get rid of this payment. I mean, if you don't want to, it's the least, right? It is the most efficient loan, okay? It's the most efficient loan, which means you're getting a deal at $96 a month with a gargantuan amount on the loan balance, $10,000 a month. Amazing. So you don't ever have to pay that off if you don't want to. Now, if you want to, great. You know how to the correct way. You understand? Man, let me say that again. You know how to the correct way. And so we want to let you know that, yes, there is some intelligence that goes into the debt snowball method. However, that method, okay, is being eclipsed nowadays by the velocity banking method. And look, it's so simple, right? Versus 4, right? You only have 2 steps. You got to make sure that you have a line of credit, right? And you know how to calculate the cash flow index, which we showed you right here. So the loan balance divided by the minimum monthly payment. And that's it. That's it. Now, I want you to do something. I'm going to present you with a challenge. I want you to make the most detailed velocity banking strategy that you can, all right? And the person with the most detailed velocity banking strategy, what are they going to get? They're going to get a $100 gift card, okay? They sure will. The one with the most detailed velocity banking strategy is going to get a $100 gift card. Okay, so now, what does that mean? That means you will be rewarded for your intelligence. You will be rewarded, okay, for implementing a system that can change your life, change your family's life, change your community's life, change your state's life, change the nation's economy, all right? So let's go through it one more time. What did we do? We went ahead and we went over the velocity banking method versus the snowball method, okay? And we made sure that we let you know that velocity banking actually increases the cash flow because it's getting rid of that minimum monthly payment. And we went over how we don't need any more stress, okay? We don't need any more challenges, right? This year or next year, we make sure that we're doing things smart, right? Doing things with wisdom, being as efficient and as effective as possible. As a matter of fact, that's why we input the cash flow index method to make sure you know the difference between inefficient loans, which is closer to 0, and efficient loans, which is going to be closer to 100. So that if you wanted to go ahead and prioritize these loans, now you know how to. And that's where it's at. So folks, don't forget, $100 gift card. I'm talking about Visa, man. Anywhere Visa is. Hey, do you know the story behind Visa? Visa, okay, Visa got its name from, that's right, the immigration visa. Why? Because it's everywhere you want to be. All right, check this out. I want to let you know that if you have a question on the velocity banking method at any time, you know what you need to do? You need to check out this video right here. God bless and have a great night.